Happy 2025. Thanks for coming back. This is You Heard It from CFP. My name is Mathew Coyle. I'm the Director of Financial Planning here at ACG, otherwise known as Advanced Capital Group. That you saw was the Iowa State House, the capital of Iowa. I was just in Des Moines for a couple days, or a day actually. Catching up with a couple clients, caught a basketball game, took some cool pictures of the State House. Did you know, by the way, that the Iowa State House is the only state house in the country with 5 domes on top of it? Did you know that? See, now you do, right? It's also one of the most beautiful state houses in the country and is covered in the center dome with 1/250,000th of an inch of pure 23 karat gold and has been gilded 5 times in its history. There you go. See? Now you know something more about the Iowa State House. Really cool place to take pictures and just walk around. Very cool environment. So let's dive in. Let's talk about earnings. Let's talk about interest rates. Let's talk about what matters to the market right now because that's pretty much all that the market is focusing on pretty much right now. Let's dive in. All right, episode 82, the markets in 2025. This time of year, once you get through the holidays and you're into January, it's January 14th as I take this video. This is the time of year when it's natural for people to ask me, the clients of our firm or maybe participants in plans that we work with, they ask me, what do I think of markets in 2025? What do I think about the incoming administration and the markets and things like that? All good questions. I think the relationship, if I could just throw my own 2 cents in, and that's what these videos are for, is that the defining story of 2025 will be interest rates and the movements in interest rates. Some fascinating things going on in the world of interest rates. Now, the stock market gets all the attention. The currency markets are probably bigger, right? But if you really want to look at the expectations for a market and you want to look and see what investors are actually thinking, the most sophisticated players in any market, they tend to be found in the bond market. The bond markets are the most important markets in the world. Like I said, currency markets are probably bigger and trade 24/7. The stock market's way more exciting and gets a lot more attention because, of course, you can make or lose a lot of money very quickly. But the true institutional, sophisticated money managers play in the bond markets. They are by far the most important investors in the world. That's where the smartest money in the world trades. And there's something very interesting going on with rates that I think is going to define 2025 and the expectations and the relationship between that and how markets perform. So let's look at something very interesting to start, and we're going to look at the relationship between the Fed cutting rates and what's happening with long rates right now. All right, so let's take a look at this first chart, and I'll just kind of put it up here and talk through it as we go. Okay, so let's talk about rates. A couple charts on rates. Now, I know you woke up today just dying to learn about interest rates. It's not the most exciting thing in the world, but it is one of the most important because it affects how everything in the economy, what things cost, how you lend your money to governments and organizations, what they pay you, what your bank pays you, what companies have to deal with when they factor in their costs. It is literally the most important thing in any market is what interest rates are doing and what the expectation, the most important part, expectation of those rates are to be. Now, usually when the Fed starts cutting rates, and the Fed has cut rates, the Fed funds rate 4 times since September of 2024. Now, usually when that happens, you see the yield on a 10-year bond rate, which is arguably the most important rate in the world, the 10-year government bond, the yield on that, the relationship between what you buy it for and what it is and what it's paying you to own it. The yield on those bonds typically falls when the Fed cuts. Typically, not always. The Fed can't control it directly. It controls the overnight lending rates between banks. But typically, the market will follow the Fed. That is not happening. We're not seeing that this time around. The black line you see in front of you is simply the average cycle around Fed cutting the rates. The green line is what we're seeing right now. So even despite the fact the the Fed is cutting rates, the overnight lending rates, and has 4 times, the market is telling us something very different. The market is telling us, the bond market is expecting it, the way it's pricing in bonds and pricing in rates, that these costs and these rates are going to keep going up through 2025. And it could affect how you invest portfolios. It could affect how you buy bonds. It could affect how you take income off your portfolios. It's a very, very important dynamic. So you're seeing this in the mortgage rates as well. Mortgage rates are higher post-September 2024 than they've been in quite a while. We've gone from roughly a 3.6 or 3.7% yield on a 10-year bond up to about 470 or 480 in a period of about 4 months. That's a big move in the bond markets. That is the bond market flashing a signal to us that it expects prices in 2024 or 2025, and rates in 2025 to at least stay where they are and possibly keep rising. So this could affect home sales. It could affect companies' profits. It could affect how the market broadens out or doesn't broaden out on the investment side. So a very interesting dynamic And it's very unusual. We don't usually see this type of relationship after the Fed cuts rates. We're seeing it now into 2025. The next one, and this one gets a little technical, so stay with me, but I'll try and make it interesting. This is a chart of what's called tens over twos. Tens over twos means the spread, the difference between the yield on a 10-year government bond and the yield on a 2-year government bond. In short, you're not going to buy a bond or basically lend to an organization or government for less money over 10 years than you would over 2 years, right? You're taking extra risk, you're tying your money up longer, you demand a higher rate of return, a higher yield on your investment to do that. When this relationship goes negative, when a yield on a 2-year bond is higher than the yield on a 10-year bond, that can precede recessionary periods in the economy. It has in the past quite often, not every time, but it has quite often, going all the way back to the 90s. So this is an interesting dynamic as well, and something that we'll be watching as we invest portfolios in the new year, into 2025. All right, let's look at earnings. If you have followed the markets even casually over the last 10 years, you know what has been driving the markets higher. It's the large companies, it's large cap growth. If you've been only invested in small cap or emerging markets or large cap international or mid caps or large cap value, you painfully know that you're not making any money. This is why a lot of our portfolios over the last 5 to 10 years have been primarily large cap growth. I can remember a time back in the early 2000s when large cap was kind of out of style. A lot of people wanted small caps, and they were outperforming. These things tend to be cyclical, but if you have been in the markets the last 10 years, you know full well that it's been the large companies, what some people are referring to, particularly the Mag 7. These are the big technology companies, big large cap growth companies. You know that these have been driving the market. This is not a secret. Well, one thing that's very interesting, and again, I think will define 2025 in addition to interest rates, are going to be the gaps, or at least the gaps between these earnings, between the largest companies and the rest of the market, so to speak. These gaps are expected to narrow. Interesting chart here. This actually comes from, I believe Bank of America put this together, but I have to look. This particular, you can on this chart, you can see the gap in expected earnings between the largest companies and the rest of the market is expected to narrow, to come down. Now, this could mean that the market is broadening out and there's more opportunity to invest. Doesn't necessarily mean it's recessionary. It could mean that we could see some value compression coming down from these larger names that present, a really good opportunity to buy as well. So if you are a longer-term investor, this could be quite good for you. If you're a short-term investor, you might expect to see some market pullbacks or some market volatility, especially with the new incoming administration. And again, I don't do politics in these videos, but with a new incoming administration and earnings expectations coming down, rates staying high, you might see some opportunities to put some money to work here if you are a longer-term investor. If you're a shorter-term investor, maybe you don't like the volatility. Maybe an opportunity to take some money off the table, but that depends on your plan goals as well and what you're managing the money for. But a very interesting dynamic. Interest rates staying high, compression between the earnings at these different companies starting to narrow a little bit. And I do think this will be the defining story of 2025 and what we see going forward and how we manage portfolios. All right, let's put a bow on this and wrap things up. So what does this mean for 2025? Well, a couple themes I think are emerging. Number one, I think rates are going to stay high and even move a little bit higher. That's unfortunately going to drive some of the costs and the things we buy, including homes, consumer credit, things like that. If you have debt to pay off in the new year and maybe something coming due or variable debt, it's a good time to pay it off. It's a good time to get your finances in order and start looking at your goals for the year. Might be a good time to broaden out your portfolios if you're managing your own money. We're looking at doing some of that here with our firm and our clients. So I think this is the year, finally, perhaps, that diversified investors are, in fact, rewarded for being diversified. A lot of good value out there that has been ignored for a while, and with a rise in rates, you're certainly going to make more on your cash, which is great. So if you're retired, it might benefit you. If you're a longer-term investor, I would take some of the volatility that I expect to see in the first half of the year and maybe put some money to work if you haven't done already, or maybe increase the amount of money you're putting into your plans. Sit down with a planner and get organized. What are your goals for the year? What are your long-term goals? Sit down, talk with somebody about it. Get a plan together. Get organized. That is my encouragement to you. Now, as far as how it relates to our clients here, I'm starting to broaden out portfolios and look at other options beyond just large cap growth, which we've been invested in a lot the last 8 to 10 years. especially in things like financials or healthcare or things that have been ignored for the last 3 or 4 years that might benefit from an incoming change in government policy as well. So, with that, this is not the official ACG dogma of the investment committee or representative of our organization, just one guy's opinion. So, take it for what it is. But I do appreciate watching the videos. Thanks again. This has been episode 82. I'll see you next time, whenever that next time is. Appreciate you watching. Appreciate you sticking with it. And yeah, take care. And thanks for sharing your time with me. I know it's your most valuable asset. So thanks. I'll see you next time. Bye.